Welcome, friends. In this series of Introduction to Stock Market, today we'll discuss about what are the things to know before starting investing. In this series, in first video, we have come across why we should invest. What are the reasons? What are the benefits of investing? Then we discuss about where to invest. Today, we will discuss about what are the things, necessary things, which we should know before investing? What are the risk reward ratio? What are the associated risk for any investment? If you are able to understand, then definitely our journey will be smooth. From beginning, we can have our clear-cut expectation and, of course, associated with those expectations. Most of the time, definitely, we will get our expectation met, but there are times when our expectation cannot meet. So we have to be ready for those eventualities, especially in case of equity investment. As far as fixed income instruments are concerned, there are no risk, and therefore there are very limited gain also. We are hardly able to beat inflation. Sometimes may happen we will not able to beat inflation. For example, we can see for last 1 year inflation was more than 8% or so, but we are not getting so much from fixed deposits, hardly getting 5 6. So we are not able to beat inflation, and we can say safely at least 1% or so, maybe 2%, we are losing on our investment. So we should be ready for such eventualities. If some emergency happens, some emergencies happen like corona or something, there are chances of inflation to go skyrocketing. But our return from fixed deposit or bond is fixed. We cannot get more than what has been given to us or promised to us while investing in those instruments. Another thing is equities, both mutual fund equities and direct stock investment. Here, comparatively, risks are more. Of course, return are more. Even in index investment, we can expect 14 to 15% return. But if you have good knowledge, you can get even more, maybe 20, 25%. But there are times when market is in bear condition, market in downtrend for long, and then it will be very difficult to find good stocks to invest and get wonderful result. But whenever this reversal happens after a long downtrend, market will go skyrocketing within very short period of time, and then we can expect exponential return within short span of time. So we should be aware of this fact. Maybe we can get exponential return in any year, particular year or particular quarter, but there is chances of the return when we will get very less return or no return. Of course, in long run, equity will give wonderful result. So if we see this mean, of course, it will be more than 15% or so. But sometime it goes beyond up, so maybe 30, 40%, 50%, or anything, 100. But sometime it goes down also beyond this main line. So we should be ready with that one. Another thing is real estate. As discussed in last video. This is illiquid asset, very difficult to get into and get out also. We will have to get right buyers, only then we will able to sell. And we have to see right time also. If market in downtrend, it will be very hard to get any prospective buyers and very hard to get even whatever our buying price. Sometimes if exigencies happens, due to some exigencies, we might have to sell at lower price. But we should be aware of illiquid part of this real estate. Another thing is location. Sometimes we might have purchased any commercial or residential properties, might be in good location, but suddenly government rules change or some infrastructure or something comes from backside or somewhere, and suddenly our prime location property goes backward and other part goes prime location. Some highway is crossing from away, and then those areas become prime locations our in. So there will be more appreciation there, and in our area there will not be so much appreciation of prices. So we must be aware of this. This is not in our control. It is beyond our control and depends upon prevailing government and their policies. Another thing is gold and silver. Of course, there is not so much return, but it is a liquid assets. Of course, we can sell anytime, whenever there is requirement of any money. Of course, we should have some portion of our portfolio in commodities like gold and silver, but we must not be expecting much return from there. Of course, in place of physical, we should have sovereign gold bond now that is available. In case of physical, there is chance of any missing out, or you can say stolen by someone. So we should be aware of theft of our precious metals. In keeping view of all these scenario, risk involved, return expected, and probability to beat inflations. Of course, we should have our major chunk of portfolio in equities, whether this equity mutual fund or direct stock. In my view, we should prefer direct stock and we should get better return over there. Of course, we should have some portion of in debt instrument, not in fixed deposit, but debt mutual fund where liquidity is more and we can withdraw or invest from our convenience. Online we can do without going to any bank or any place. And some person, of course, in gold. Of course, we have to have our, if we have office or our residential. So that much portion we must have. We should not have any extra house in my view. Why we should not have? We will dwell upon this in another video. Of course, another part of stock market also will discuss in next video. So all major part of investment risk involved we have discussed today. So we will discuss stock market, other parts and other things one by one in capsule form so that you will be digest those knowledge and have wonderful result after finish of this series. Thank you.